you hear me? Can everybody hear? Welcome to our Oktoberfest. I hope everybody put their body armor on. Last coaching session we had with Taya Kyle, and that was a kinder, gentler coaching session. But today, I hope you brought your body armor because we're gonna have some really good coaching. So the first thing I want to ask. Do I have your permission to coach you? By show of hands, let me see your hands. Do I have your permission to coach you? Okay. Now, for some of our guests, what is coaching? What is investor coaching? What I do is I help my clients avoid the pitfalls, traps of imprudent investing. You know, like buying high and selling low, things like that. So, tonight we're going to talk about gearing up for the next crash. I know the market's been frothing around a little bit. I've already gotten a few phone calls, and that's why it's very, very important you guys come to coaching, because we answer your questions, we help assuage any concerns and fears that you may have, and help you sleep at night. And that's the whole thing is we want you to be able to sleep at night knowing that, hey, it's good, everything's covered. So we're going to jump right in. You know, the market has always been, I guess, frothy or has volatility. As you can see up here on the chart, this is from the S&P from 7 of 1984 all the way up to 6 of 2014. And that's $100,000. And you can see, if you can see where my little laser pointer is, you can see there was a big drop. You can't see the numbers, but that's around the 2000, 2001 when we had the big tech drop. And then this is the one that we went through in 2008, 2009. So you look at it and you go, well, gee, that's kind of scary, Tim. But if you think about it, that $100,000 in that 30-year period would have grown, if you'd left it alone, to over $2 million. 100,000, walk away with $2 million. How many of you would sign up for that every day? Yeah. So that's what I'm trying to talk to you about, and that's what we're going to talk about tonight is you don't have to fear the impending crash. I don't know when it's going to happen, but there will be one. We've already had several, but they're nothing really to worry about if you stay cool, calm, and collected. And that's what I'm here for, is to help you do that. The problem is when the market's at an all-time high like it has been, what happens? People get fearful. They fear the pullback. They go, oh no, it's going to pull back. And so they want to bail out and they want to get out of the market. And that's the worst time to get out, because you don't know if it's the high. How do you know if it's at the high or if it's going to go higher? I mean, it's the future. The future is unknown and it's unpredictable. So how are you going to know that it's at the high that it's going to ever get to?
So let's get right to it. In today's market action, we have Mark Matson, Matson Money CEO. He's going to tell you how to get the highest returns from your portfolios no matter what the market's doing.
Mark, we are closing today at a 14-year high for the NASDAQ.
Wow.
Let's marry what Scott Bowers said with how you feel about whether people should be in stocks.
Well, what happened was, in 2008, 2009, a lot of people got panicked out of the market, and they've been waiting for this period of certainty where they know for sure that it's safe to get in. But guess what? That period is never going to come. Just because we're at an all-time high doesn't mean anything about the near-term future. Keep this in mind. 2 out of every 3 years, the market is up, and it's up about 20%. When it's down 1/3 of the time, it's only down about 13%. You've got to be in it now, and you've got to be in it long-term. I'm thinking about the next 200%, not the next 20%.
Actually, Mark's numbers are just a little bit off. It's more like 70%, 30%. Market's up 70% of the time and down 30% of the time. 2 out of 3 works when you're on TV, but It's a little closer to 70-30. But if I had a casino and I said, okay, you're going to win 70% of the time, but you're going to lose 30% of the time, I bet you there'd be a line out the door and I'd be going bankrupt trying to keep the money from hemorrhaging out my pockets. So it's not that big a deal when you see a pullback or a market correction. And if you're waiting for certainty, you're going to wait forever. There's just volatility in the market, and you're always going to have it. It's always going to be there. So you just have to get used to it and realize that it's good. Volatility really is good. I don't know when the next crash is coming. Maybe it's started, maybe it hasn't. I don't know. What I do know is that I don't know where the next 20% is, whether it's going to be up or down. I know where the next 200% is going to be, and that's going to be up. I can guarantee that the next 200% move is going to be to the upside. So what's the problem? The problem is the investors, you guys. Told you, you're going to have your body armor on for coaching tonight. How many of you, and I know we've got some here tonight, how many of you were with me and rode out the market 2008, 2009? Show of hands, how many were with me and rode it out? And we recovered, right? Recovered nicely, right? So those of you that are fairly new clients of mine, you're untested. You haven't seen what happens when the market goes down, and you haven't faced your demons and your fears. Well, I'm here to help you and to keep you from making bad mistakes like selling low and buying back in high. 76% of all Matson Money clients came on after the market downturn. The market bottom was 319 of 09, so that was the absolute bottom. So there's a lot of people that have come over, not just for me, but for Matson Money. 76% of them are untested. We don't know if they're going to panic. We don't know if they're going to bail out at the first sign of trouble. So that's why we're doing the coaching. You can see the volatility from 1999 through 2014, and you can see this is 2001, then it came back. Here's the 2008, 2009, and then look what happened. Boom, skyrocket. So $100,000, 331 from 331 2009 grew to, it went down, it was probably about $60,000, but then came roaring back, and at the end of June of 2014, $189,000. So it goes down, it comes back up. The key is to not panic and get out. Look at that. Almost a rocket ship going straight up. One of the worst possible things an investor can do in a down market is panic and sell. Let me ask you. We've had a real estate crunch during that same time. If your house value went down 20%, would you sell it? Let me see, show of hands. Who would have sold their house when it went down 20%? Oh, it's down 20%, I got to get out. I don't see any hands. How about this? You buy a brand new car. You drive it off the lot. Boom, instantaneously, it's depreciated 20%. Oh, well, it's down 20%. I better sell it. You don't do that with other things. In fact, when I will bet you, let me ask you this. How many women in here go to the store and look for sales? They want to find a bargain. They want to. If it was 20% off, what would you be doing? Would you be buying or would you be selling? Yeah, you'd be buying, right? Okay. So why would you do that with your portfolio? You shouldn't, and you just really shouldn't. Everybody knows you have to buy low and sell high. So why do they do it just the opposite? The biggest reason is fear and greed, mostly fear. And it goes back all the way back to caveman days. It really does. It goes back to the caveman days. Our gut basic instinct is fight or flight. That's our basic instinct, is to fight or flight. When the big saber-toothed tiger came jumping around the corner and scared the caveman, he had two choices if he was going to live. He either fought the saber-toothed tiger and he killed it, or he ran away to fight another day. And so that same instinct is just hardcore, hardwired into us, and that's all we want to do. We want to either fight or flight. Well, how do you fight the stock market? You can't fight the stock market. You just can't. There's no way to do it. It's a inanimate object. It's ephemeral out there. So what do you do then? Okay, your other instinct then is flight. And that's the worst thing that you can possibly do, is to take flight or get out at the low. You've really hurt yourself. You've really hurt your financial future and your peace of mind. One of the best times to buy equities is in a crash. We just talked about it. You buy when there's a sell. Why would you want to get out when there's a fire sale going on stocks? Usually when we have a crash, there's a massive transfer of wealth. And the massive transfer of wealth is from those that panic and get out and sell at the bottom. And the wealth is transferred over to those that stay invested or buy even more, like we do when we rebalance. That's where the wealth gets transferred to, because they've been prudent and they've stuck with it. I'll tell you a quick story, and it pains me a little bit, but there wasn't much I could do. Got a call from one of my clients. I had inherited him from another financial advisor that had gotten out of the business. And he called me, I guess it was spring of 2010. And he was literally, I'm not kidding, he was literally in tears. He was crying. And I go, Steve, what's wrong? What's going on, man? You're really upset. He goes, I sold out and got out of my 401k and all my IRAs and all my investments March 1st of 2009. The bottom was March 19th. And he still wasn't back in. And he was still afraid to get back in. And he was crying to me saying, I'll never be able to retire. I had planned on retiring and moving to Kill Devil Hills and having a house on the beach. He goes, it's gone. It's all over. I'll have to work the rest of my life. And I had tried to work with him. Like I said, he was a client that I inherited from someone that got out of the business. And the feeling of helplessness that I had was just atrocious. I really wanted to help him. So that's why I'm doing the coaching. That's why I do the coaching with you guys. If I can help prevent that kind of a issue with you guys, then I feel that I will have done a good job by you. A lot of people say, well, I hate the volatility. I just hate when it goes up. I hate when it goes down. It just drives me crazy. I see it, the market go down 300 points, and it just scares me. You don't hate volatility because you really actually like volatility. When the market's running up, remember the chart I showed you. When the market's going up, and it's going up for 5 years straight, you're going, woohoo, baby, I'm making some money now. And so you're happy, and you like the volatility. You don't like the downside volatility. But unfortunately, just like when you get married, there's good things and there's bad things. Am I right? Marion's laughing. Now, you want, just like the market, you want 70% of it to be good, and hopefully only 30% to be bad. But you still, it's just like a marriage. You want to stay with it. You want to stick with it because the good times are going to far and away outweigh whatever happens during the bad. So why are we doing this session? If you're not prepared now, you never will be. And it's too late once the market does tank. You know, if the market went down, well, let's just say 10%. I'm going to move over here and show you something. The Dow high was 17,200, and that was in September, about September 9th or so. That's when the final Dow hit the high that it's ever hit, 17,200. So if we have a 10% correction, we haven't even come close to that late, with what's been going on as of late. That's 1,700 points for the market to drop. We haven't even come close. Market today closed at what? Something around 16.8 or so, something like that. It's nothing. It's not a big deal. We'd have to get down to 15,500 before we have a 10% correction. And trust me, a 10% correction's nothing. It's not a big deal. You can make that back really, really quick. So what is a crash? A crash is a sudden dramatic decline of stock prices across a significant cross-section of a stock market. Okay? 10% or greater is usually what the standard theory is. So let's look at how many stock crashes we've had. Let's just take the S&P from 1926 through 2013. There's 88 periods. 64 up and 24 down. The ups averaged 21.67%. How many of you would sign up for that kind of volatility? 21%. Yeah, that's what I thought. Down average, 13.6. That's why I use the 10%, because a little bit less, but anything over 10% is considered a strong correction. You got to have one without the other. It's just the way it is. But if I told you those odds, how many of you would really be signing up for it? Every hand should go up. All right, so the annualized return during that period is over 10%. Now, those of you that took basic math, remember the rule of 72. So if you have a 10% return, rule of 72 says your money is going to double every 7 years. Now, if I didn't tell you what the returns were, I didn't tell you what the investment was, I just came to you and said, I'm going to double your money every 7 years. Show of hands, who would be signing up for it? Okay, so why do you care if the market drops a little bit? Using the annual market performance, we looked at 20% or greater drops. The S&P had 3 separate 20 to 29% calendar year drops since 1926. It had 3 separate 30% calendar drops from 1926. The 20% drop happened around the 2001, the tech bubble crash, and then the 30% drop, or over 30% drop, was the 2008-2009. We know how to weather the storm. Between Matson Money and myself, we know how to weather the storm. We buy, we rebalance, and we diversify. We have a very diversified portfolio. We have over 12,000 unique holdings. That's a lot of different holdings to have, and it's globally diversified, 45 countries. So we're using not one, but 2 Nobel Prize laureates' economic theorems to manage your portfolio. It's all based on science. There's no pie in the sky. There's no, we think this will happen or that will happen. It's all scientific. So let's look at some of the Matson Money performance. This is from July of 92 through June of 2014. This is the aggressive growth. And you can see, looking at the aggressive growth, you can see some pretty horrendous drops. The green line is before fees are taken out, and the blue line is after any fees have taken out. But we're looking at $1 million from July of 92 when Matson started to June of 14. And then, of course, down here, this little line is the Consumer Price Index. So here's your 2002. That was our 20% drop. 2008, there's the 30% drop. If you had invested $1 million in July of 1992, Consumer Price Index says it should be worth a minimum of 16 or 1.6, almost 1.7. Any guesses what the aggressive, which is basically all invested in stock, was worth? Bam, 5.5 million. So I know a lot of you may not have a $1 million to invest, but think of it as 100,000. If you had invested 100,000 and just let it ride, even through the ups and the downs, you'd have $550,000. And that's hard to do. I understand that. This is the aggressive portfolio. I don't think we have anybody in here that's in the aggressive. And what do? We use short-term fixed income to take some of the volatility out. So on, I don't have it on the slide, but I just know the numbers. On a growth portfolio, which is 75% fixed income, or 75% equities, and 25% fixed income, you still would have made $4.4 million on that $1 million. And then on a balanced portfolio, which is 50-50, very conservative portfolio, 50% in equities, 50% fixed income, you still would have made about 3.2. So you would have had a triple, a quadruple, or a quintuple just by letting us do our thing. The crash is never the problem. It's the untested ones and the investors making bad choices. Dalbar is a research company. They do research on investors and how they think and how they act. So if you look at this Dalbar study, it shows that from 1984 to 2013, just the S&P, just a broad index of the market, did 11%. The average investor, 3.69. Why? Because they chased the hot stocks, because they got out at the low, because they didn't stay prudently invested, and probably because they didn't have a coach to tell them, no, we're not going to go to cash because we're going to ride this out and we're going to rebalance. The CPI, which represents inflation, 2.8. So after you pay taxes, you're going backwards. That's a negative. I mean, that is horrendous. And that's what the average investor has done. We're looking at almost 30 years. How would you feel if you hadn't made any money on your investments for 30 years? That's why you have a coach. And you know what? Investors are still terrified of equities. They did some research, I think it was out of Princeton, and they asked people, are you more inclined to invest in the stock market? 73%, and this was just recently, this is 2014 study, 73% said no. And why? Well, they've been burned at least twice and probably 3 times. They got out at the bottom of the tech crash. Market started going back up, so they jumped back in. Then they got burned on 2008, and now the market's back up again, and they've just been burned. And so they're afraid of the stock market because they've done all the wrong things. And I've kind of summarized why. They've been wrong twice. And it's not always the investor's fault. If you look at CNBC or MSNBC or any of the shows that are on, fear and pessimism sell. That's what gets the ratings. You know, I've told you guys before, those of you that have been my coaching clients for a while, if it bleeds, it leads. That's the way the media portrays it. They just want the grit. They want the nasty stuff. If it bleeds, it leads. Think about what's in the news now. Man, it's all Ebola, Ebola.